Usually when we talk about predicting the future, we tend to think of it like forecasting the weather. I mean, you look at the current temperature, you measure the wind speed, you check the barometric pressure, and then you just run the math to see what's coming.
Right, exactly. Because it's an independent system. The storm is going to arrive whether you bring an umbrella or not. Your personal actions, that they don't actually change the weather.
Exactly. It's clean. It's observable. But what if we step into a world where just the act of bringing your umbrella actually causes the rain to fall? Like a world where observing the system literally rewires the system itself.
Oh, that's the perfect way to frame it.
Yeah. Well, welcome to the deep dive. Today, we're decoding the mental frameworks of history's greatest investors. And look, this isn't to give you stock picks, but to show you how these titans hack human psychology and probability to win. We are exploring how they process information, how they define risk, and how you can apply these master-level frameworks to your own life.
And we are covering a really vast landscape of thought today. I mean, the sheer diversity in how these minds approach risk and reward is staggering.
It really is.
We're looking at day traders who capitalized on chaos, corporate agitators who forced companies to bend to their will, and even the pioneers who realized that sometimes doing absolutely nothing is the sharpest mathematical advantage you can have.
Okay, let's unpack this. Because to understand how to beat the market, we first have to understand how to value a business in the first place. I mean, you can't hack the system if you don't know how the machine is built, right?
Absolutely not.
And that brings us to the bedrock of modern investing. We're talking about Benjamin Graham, Warren Buffett, and Charlie Munger.
Yeah, you really have to start with Benjamin Graham.
Yeah.
He's universally recognized as the father of value investing because before Graham, investing was, well, it was largely treated like roulette.
Like gambling, basically.
Exactly. It was highly speculative, driven by rumors, insider tips, momentum. But Graham drew a very hard line between investing and speculation. To him, an investment operation must thoroughly protect the principal and provide an adequate return. And the only way you achieve that is by demanding a margin of safety.
Let's really dig into that margin of safety, because it sounds simple, but the mechanics of it are actually brilliant. It's essentially structural engineering applied to finance.
Oh, I like that analogy.
Right. Because if you're building a bridge that needs to hold a 10,000-pound truck, you don't build a bridge that can hold exactly 10,000 pounds.
Right, because one strong gust of wind and
it collapses.
Yeah.
So you build one that holds 30,000 pounds. So in the market, you only buy when the price is significantly lower than the intrinsic provable value of the company's assets.
Precisely. If the math says a company is worth $50 a share, you don't pay 48, you pay 25. That gap, that's your margin of safety.
It's a buffer.
Exactly. It absorbs the shock of unforeseen events or, management mistakes or economic downturns.
And his most famous student, Warren Buffett, took that philosophy and totally weaponized it early in his career. I mean, think about what Buffett did as a young man.
The J.I. Co. story.
Yes. He discovers Grandma's on the board of Geico Insurance. But Buffett doesn't just read the annual report. He literally takes a train to Washington, D.C. on a Saturday, goes to Geico's headquarters, and knocks on the door until a janitor lets him in.
Which is wild to think about today. And that led to a massive hours-long conversation with Lorimer Davidson, the vice president of the company.
He just walked in and talked to the VP.
Right. But it perfectly illustrates how much Buffett valued deep, firsthand understanding of a business. He wasn't relying on secondary analyst reports. He wanted to understand the actual unit economics of auto insurance straight from the executives running the floor.
And he was brilliantly aggressive with this framework early on, too. Look at his activist play with the Sanborn Map Company in the late 1950s. This is like the ultimate masterclass in Graham's margin of safety.
Map business, yeah.
So Buffett noticed Sanborn's stock was selling for $45 a share. The company made detailed maps of cities for fire insurance companies. But their map business was declining, so Wall Street basically left the stock for dead.
Right. Everyone ignored it.
But when Buffett dug into the balance sheet, he saw that Sanborn had been quietly funneling its early profits into a massive portfolio of stocks and bonds. And that hidden investment portfolio alone was worth $65 a share.
The math on that is just wild when you break it down. Because, okay, if the liquid investments inside the company are worth $65 and you can buy the whole company for $45, The market is essentially valuing their actual operational map-making business at -$20.
Mine's $20. It's crazy.
It really is.
So Buffett didn't just buy the stock and hope the market figured it out. He and his partners bought up enough shares to force their way onto the board, and then they pressured the company to distribute that investment portfolio to the shareholders. It was a guaranteed mathematical win.
But as Buffett's empire grew, his partner, Charlie Munger, helped evolve this strategy. Munger pushed for what he called a latticework of mental models.
Right, moving beyond just the balance sheet.
Exactly. He believed you couldn't just use financial metrics. You had to borrow from physics, biology, history, and psychology to truly see the whole board.
Munger's toolkit is legendary because it's entirely multidisciplinary.
Yeah, he relied heavily on concepts like inversion. The idea is that complex problems are often easier to solve backward. So instead of asking, how do I make a brilliant investment, Munger would ask, what are the absolute guaranteed ways to destroy my capital?
Oh, I love inversion. Because, if I want to be a terrible investor, I should trade constantly, pay massive fees, chase hot trends based on emotion, and borrow heavily on margin.
Precisely.
So to succeed, I just systematically avoid doing all of those things. It flips the problem completely on its head.
It clarifies the path by identifying the landmines. And he also constantly weighed opportunity cost, ensuring every choice was measured against the next best alternative. And then there's his concept of the Lollapalooza effect.
Let's apply the Lollapalooza effect to something modern, because I think people misunderstand it as just, things going crazy. It's actually very specific. It's when multiple independent psychological biases or systemic factors converge in the same direction at the exact same time.
Yes, that convergence is key.
Right. Look at the GameStop short squeeze a few years ago.
Yeah.
You had social proof, right? Everyone on Reddit doing it together. You had gamification of the trading apps making it addictive.
Ooh, the confetti and everything.
Exactly. And you had the systemic mechanics of massive short interest forcing hedge funds to buy back shares.
Yeah.
Plus, you had authority bias from influential figures tweeting about it. It wasn't just one factor.
Right. It was a perfect storm of converging human biases and market mechanics that created an outcome that drastically exceeded normal expectations. That is a flawless application of the concept. And Munger warned heavily against what he called single hammer thinking. The old saying that to a man with only a hammer, every problem looks like a nail.
Right.
If you only look at the world through the lens of a balance sheet, you will completely miss the Lollapalooza effects forming in the psychology of the market.
Right, because navigating the market with just a P/E ratio is like trying to drive a car by only looking at the speedometer.
Yeah.
It tells you your current price, but it tells you absolutely nothing about the traffic, the weather, or if there's a cliff 100 yards ahead.
That's a great way to put it.
But let me push back on this early value framework. If Graham and Buffett are hunting for fundamental mispricings, buying things for less than their parts are worth, isn't that just bargain hunting at a garage sale? Where does that leave the everyday investor who doesn't have the time or the capital to tear apart corporate balance sheets and force board resolutions?
What's fascinating here is how that strategy had to evolve, even for Buffett. It started as bargain hunting, buying what Buffett called cigar butts with one good puff left in them.
The discarded stuff.
Yeah. But Munger pushed Buffett to realize that it's not just about cheapness. It's about finding durable competitive advantages, companies with strong brand loyalty and pricing power.
So buying a great company at a fair price.
Exactly. Munger believed that compounding isn't just a mathematical formula, it's a mindset. You buy a great company at a fair price and you let the business compound its value over decades.
So if Graham and Buffett require this intense, multidisciplinary analysis, let's look at strategies designed for the everyday person. Because here we find a massive divergence in how to apply everyday knowledge. We have Peter Lynch on one hand and Jack Bogle on the other.
These two represent fundamentally opposite views on how an individual should approach the market. Let's look at Peter Lynch first. He managed the Fidelity Magellan Fund and generated an absurd 29.2% average annual return over 13 years.
Unbelievable numbers.
Yeah, and his core philosophy was invest in what you know, but that gets vastly oversimplified.
Right. Because people hear that and think, oh, I like my iPhone, so I'll buy Apple stock. But Lynch's strategy was much deeper than that. He didn't buy Dunkin' Donuts stock just because he liked the coffee.
No, not at all.
He used his daily observations as the lead. He noticed the shops in Boston were always packed. He noticed the customer loyalty. That observation is what prompted him to go look at the financials.
Exactly. And what he saw was a highly scalable franchise model with low overhead and incredible unit economics that Wall Street analysts in New York, frankly, hadn't noticed yet.
Because they weren't in Boston drinking the coffee.
Right. He believed that by observing local trends, the everyday person could spot immense growth opportunities well before the institutional money caught on. He was hunting for the 10 baggers. That's a baseball analogy for a stock that makes 10 times its original purchase price.
Okay, 10 baggers, got it.
And he popularized JARP, which stands for growth, at a reasonable price. He was perfectly willing to pay a higher PE ratio for a company if the earnings growth rate justified it.
So he married the discipline of value investing with the upside of growth investing. But then, entering the ring from the completely opposite corner, we have Jack Bogle, the founder of Vanguard, and his approach was entirely different.
Night and day. Bogle looked at the broader data and realized a staggering truth. The vast majority of active mutual fund managers completely failed to beat the market over the long term.
Wait, really? The professionals?
Yes, the professionals. And why? Because of the frictional costs, the high management fees, the transaction costs from constantly trading, the taxes. So in 1976, he democratized indexing with the first index investment trust.
Instead of picking stocks, he just bought them all.
Exactly. Instead of trying to pick the winning stocks, he just mathematically bought the entire market and kept the fees near zero.
And the arrogance of Wall Street at the time was off the charts. They ridiculed this idea. The sources show they called it un-American and a sure path to mediocrity.
Because it threatened them.
Yes, because Bogle's simple math humiliated them. It threatened their entire fee structure. I mean, if you have two investors and one pays a 2% management fee every year while the other pays 0.05%, the compounding effect of that saved 2% over 30 years is astronomical.
It's massive. And Bogle created what's known as the Vanguard effect. Vanguard's low-cost, mutually owned structure effectively forced the entire asset management industry to slash their fees just to survive the comparison.
And we see other variations of finding these edges, too. Briefly, you have someone like Thomas Rowe Price Jr., who pioneered growth investing, or John Templeton, who pioneered emerging markets and contrarian investing.
Right. There are many variations.
But wait, I have to push back on the core contradiction between our two main guys here. Lynch tells you to buy Dunkin' Donuts because you like the coffee and do your homework, but Bogle says average investors can't possibly beat the market, so you should just buy the whole index. Who is actually right?
Well, it fundamentally comes down to where you believe the advantage lies. Bogle prioritized minimizing the frictional costs of investing, low turnover, simple strategies. He believed keeping costs near zero was the only mathematically guaranteed edge.
Okay, and Lynch.
Lynch, however, believed that doing rigorous homework on local knowledge gave individuals a genuine informational edge over Wall Street professionals. They both succeeded wildly. They just exploited different inefficiencies in the market.
Okay, so Bogle passively accepts the market, and Lynch observes it. But what do you do when you know a company has massive intrinsic value, but the management is complacent, lazy, or actively destroying it? You don't just wait around, you force the change. And that brings us to the agitators. Enter Carl Icahn.
Carl Icahn is a completely different species of investor. He transitioned from being a feared 1980s corporate raider into a highly influential shareholder activist.
What does that mean in practice?
He targets companies that are deeply undervalued due to bad management, acquires a major stake, and then relentlessly forces structural changes to unlock that shareholder value.
His reputation is so lethal that the market actually coined the term the Icahn lift. A stock price will literally surge simply because Wall Street anticipates Icahn will uncover shareholder value by targeting a badly managed company.
He just shows up and the price goes up.
Right. We're talking about forcing asset divestitures or completely shaking up the board of directors. I mean, the sources mentioned TWA, RJR Nabisco. He even pulled a massive $1.9 billion profit out of Netflix.
And his mechanics are fascinating. Recently, he initiated a proxy fight with McDonald's over the ethical sourcing of pork, specifically the use of gestation crates for pigs.
And how many shares did he have to do this?
That's the incredible part. He only owned 200 shares of McDonald's.
200 shares. That's nothing for a company that size.
It's a tiny fraction of a percent. But under SEC proxy rules, any shareholder with a minimum qualifying stake can submit a proposal to be voted on at the annual meeting. He used that microscopic stake to legally nominate 2 directors to their board.
It's the ultimate use of leverage. It reminds me a bit of the mechanics behind John Neff, who ran the Windsor Fund. Neff was a contrarian who spent his entire career arguing with the market by focusing on low PE ratios.
And another aggressive approach, yeah.
But I want to go back to Icahn for a second, because Icahn sounds to me like a ruthless house flipper. He buys a messy property, fires the lazy contractor, and forces the property value up. But the sources mention this specific tactic, greenmail. Explain the mechanics of greenmail to me, because isn't that just legal extortion?
It is one of the most fiercely debated tactics in financial history. To explain it impartially, the mechanics work like this. An activist buys a massive block of shares in a target company and essentially threatens a hostile takeover.
Like we're going to fire everyone.
Right. They threaten to replace the board or break up the company. The existing board of directors panics, naturally wanting to keep their jobs in control. So the company uses its own corporate cash to buy back the activist shares at a massive premium just to make them go away.
So the company basically pays them a premium just to leave them alone. The activist walks away with millions.
Exactly. And there is a deep structural tension here between immediate shareholder returns and sustainable long-term value creation. Activist investors believe that they are fixing broken management, that the threat is a necessary catalyst.
And the critics?
Critics argue that it disrupts corporate stability, that draining a company's cash reserves for greenmail hurts long-term growth just to pump up the stock price. It's a fundamental debate.
Okay, so we've gone from valuing individual businesses on a balance sheet to literal boardroom brawls over proxy votes. Now we need to pull the camera all the way out. We are zooming out from individual companies to look at massive global systems, psychology, and the underlying nature of reality and finance.
We're stepping into the realm of the macro speculators. And the pivotal figure here is George Soros. In a famous 1994 speech at MIT, Soros laid out his theory of reflexivity.
And this goes against classical economics, right?
Vehemently. Classical economic theory assumed that markets naturally tend toward a stable equilibrium. Soros disagreed completely.
Here's where it gets really interesting. Reflexivity. Soros argued that the participants' biased thinking doesn't just evaluate the fundamentals of the market, it actually shapes and changes those fundamentals.
Yes. He defined reflexivity as the continuous two-way feedback loop between what he called the cognitive function, us trying to understand the world, and the participating function, our actions changing the world.
It's like a rumor that a major bank is failing. Let's say the bank is actually perfectly healthy, but the rumor starts, people believe it, and they panic.
Yeah.
That belief makes everyone rush to withdraw their money. And the physical act of millions of people withdrawing their money drains the bank's reserves, which actually causes the bank to fail.
If we connect this to the bigger picture, that is exactly it. The belief creates the reality.
The biased belief created the fundamental reality.
And Soros used real historical boom and bust cycles to execute massive trades on this. Take the conglomerate boom of the 60s or the international lending boom of the 70s and 80s.
How did the lending boom work with reflexivity?
Well, banks relied on a country's debt ratios to decide if they could lend them money. But Soros pointed out that the very act of banks lending massive amounts of money stimulated those local economies so much that it actually improved their debt ratios on paper.
Oh, wow.
The influx of capital changed the economic reality, making the countries look safer than they were, which led to more lending.
So Soros recognized that causal indeterminacy and used it to make highly leveraged short-term bets based on instinct and global trends. He embraced the chaos rather than fearing it, and he wasn't the first system-level thinker to do this. You look back at Jesse Livermore, an early pioneer of trading on systems and technical analysis.
Very true.
Livermore made millions shorting the 1906 earthquake and the 1929 crash solo. And if you bring that system-level thinking into the modern era, you have Ray Dalio at Bridgewater Associates.
Dalio views the global economy as a machine, right?
Exactly.
Yeah.
Driven by his distinct principles of an idea meritocracy and radical transparency to navigate that economic machine, which really brings us full circle. Because whether you're building a latticework of mental models like Munger or looking for 10 baggers at your local coffee shop like Lynch,
or recognizing the self-fulfilling prophecies of Soros's reflexivity.
Exactly. These aren't just financial tools. They're entirely different lenses for viewing human behavior and opportunity.
They are deeply robust frameworks for decision-making in a world defined by profound uncertainty.
They really are. And I want to leave you, our listener, with a final thought to mull over. We've spent this entire time dissecting the minds of billionaires, analyzing how they accumulated massive wealth. But let's look one last time at Warren Buffett. The sources note Buffett's belief that while the rich earn outsized rewards in a market economy, Society has an obligation to ensure nobody gets left too far behind.
Right. A major shift in perspective.
Buffett is currently giving away 99% of his fortune, primarily through the Gates Foundation and his children's charities. He stated he wants to give his kids enough to do anything, but not so much that they do nothing.
It is a profound philosophical shift from accumulation to distribution.
Exactly. So here's the question for you to explore. If the ultimate endgame of history's greatest wealth builder is to aggressively give it all away, what does that teach us about the true purpose and value of accumulating wealth in the first place?
It certainly makes you rethink the definition of a successful investment. Thank you for joining us as we explored these incredible minds today.
Yes, thank you for coming on this deep dive with us. And next time you look at the forecast, just remember, you might be the one causing the rain by carrying the umbrella. See you next time.